We're going to hold questions on the audience, but you can reach any of the panelists in the networking reception. I encourage you to do so. So I am Nisa Amoils. I run a venture capital fund in this sector. Blockdaemon is one of our seed investments, earliest investments, must disclose. Also, part of Dragonfly Capital as advisor and $2 billion crypto fund. I'm going to ask all of the panelists to give their introductions, starting with you.
Sorry. Hi, happy to be here. My name is Ahmad Deek. I run a crypto hedge fund. We focus on systematic strategies and arbitrage in DeFi mainly.
My name is William Evans. I'm with CEXIO. We're a crypto exchange, digital asset exchange. More well known in Europe. We're making a push here in the Americas. My background is TradeFi. I came from CME Group, where I spent quite a few of my years there and worked with the team to launch Bitcoin reference rate as well as the Bitcoin futures and Ethereum futures.
My name is Jason Price. I'm the Director of Regulatory Relations. So I manage at Blockdaemon, the regulatory and policy strategy. My background is a bit diverse from most folks up here. I spent most of my career in the intelligence field, working for the NSA and CIA. I also was in investment banking and spent some time at DEA tracking illicit activity.
So you know everything about us then.
Yeah.
Hi, my name is Richard Johnson. I'm the founder of Texture Capital. We're a digital asset securities broker dealer, so we're focused on tokenizing regulated securities. We help companies who wish to issue a token that represents equity or fixed income or revenue share or royalties, these types of investment contracts. And we have an ATS, alternative trading system, for secondary trading of tokens.
Great. So this panel is about institutional DeFi, and going to start with you, Ahmad.
Sure.
Where are we in that, or DeFi 2.0, as it's affectionately called?
Yeah, I mean, I hate that name, DeFi 2.0, because we're still, I think, in less than 0.0 right now. So my answer is we're very, very early, right? The longer answer that's a bit more nuanced is, it's good to compare where we are in a cycle versus other cycles that we're familiar with, right? So if you look at Web 2.0 or 1.0, we started the internet in a messy environment where the first thing we did was we put content online for people to read, right? And we figured out we can actually have people put content in. So we build that framework. And now we're in a cycle where we are figuring out how people can actually put content on the internet and own it, right? And so, the field is evolving. And you can take crypto, or at least DeFi, and look at it in the same lens, right? In banking, first we were able to put money in banks, and we didn't own it, and we didn't do anything with it, right? And we figured out that, in fact, we can put money in banks and still be able to see transactions, we can make payments, we can, to a limited extent, invest it ourselves, right? And now in DeFi, we're saying, well, we want to own our money and we want to be able to invest it and move it around and have full ownership without anybody telling us whether we can have it back or not, right? So we're in the early phases of that, right? Whether we're talking about retail or institutions, right? But we're missing a lot, right? We have a long way to go and it's going to be a very messy road, right? And people are going to get hurt, some more than others, as you might be reading these days, right? But there's a lot of things that need to happen before we can at least say that we are at the same level as the beginning of the traditional capital markets. We don't have good liquidity, we don't have a lot of products, we don't have regulation. So we have a lot to go, right? But it's an exciting field, it's a growing field, a lot of very interesting people are in it, and we are building the next generation financial infrastructure for the world, right? So it's a big ask.
Will?
Yeah, I echo kind of what you're saying. I think, DeFi 1.0, 2.0, it's analogous to, software releases, evolution. And that's what we're going through. I think it's akin to traditional markets, at CME Group, I was there at the time that we went electronic trading. We went from open outcry to electronic trading. There was a lot of pain. There was a lot of issues with the technology, Regulations had to change as well to some degree. So, when we say what's in DeFi 2.0, I think it's a lot of things, right? It's not just, more secured smart contracts. It's not just better UX for customers, retail customers. It's regulatory, it's legal, it's the whole ball of wax. So I think, however we enumerate, we're going to be going through this for a while. We'll be up here on the stage in 2 years talking about DeFi, 24.0. So I think, especially with recent events, I think that pushes us forward even quicker, right? Some of these market events, the macroeconomic backdrop force, innovation and evolution and refinement. And so, in all, I think coming out of this is going to be interesting for sure in terms of advancing even faster. So our pace, I think, is only going to pick up as we go forward. It's fast enough as it is.
Absolutely. So, I think DeFi V1 is dealing with a lot of risks, and DeFi V2 is mitigating those risks. For example, smart contract audits are going to be conducted in V2 by insurance companies, and you're going to see volatility reduce, not drastically, but it will start reducing based on financial institutions providing more liquidity. And also, insurance companies are now covering certain risks across the DeFi space. Look, right now, the top 10 financial institution asset managers are managing $40 trillion, right? In terms of ETPs, ETFs, and those products, there's only a handful of institutions that are, emerging in the market. But, at Blockdaemon, we've had multiple discussions with several heavily regulated financial institutions that want to discover how they fit in and where they fit in and the nuances of DeFi. They're all interested. I don't know if you guys saw the survey done by Fidelity, but 7 out of 10 asset managers are trying to figure out how to procure these assets and get exposure over the next 60 months. So it's happening. I think, everyone in crypto, as soon as someone says a financial institution is looking at crypto, they think it's going to happen tomorrow. You still have to realize that a lot of regulatory frameworks haven't been embedded, right? We're still trying to figure out how to tax assets, how to work with POW mining. I was just on the Hill 3 weeks ago, and the discussions on the Hill were around the Terra fallout, POW mining, the FTX proposal, right? Nothing about staking, nothing about liquid staking, nothing about lending, nothing about borrowing, right? So I say all that to say, I think the market's still in its infancy, and we have a long way to go, but there's certainly heavy interest from the institutional side.
And Jason, what is Blockdaemon providing to institutional investors in terms of Starkware?
Yep. Good question. So Blockdaemon, we manage and deploy nodes, right? So effectively servers with the protocol running on these nodes. We evaluate. So a lot of financial institutions come to Blockdaemon to figure out how they can gain exposure in a safe and regulated way. We just launched, and I don't mean to skip ahead, but we just launched a platform, a permissioned ecosystem with another DeFi protocol called Stakewise that allows financial institutions and other institutions globally to gain exposure to liquid staking for Ethereum. So with Ethereum still dealing with the merge, and then they have to deal with the withdrawal aspect. Institutions want access to that capital, right? They don't want to wait on the merge. They don't want to wait on the withdrawal execution to be implemented. So we created a permissioned ecosystem, which is just one way that Blockdaemon is working with financial institutions to allow these heavily regulated institutions to gain exposure to DeFi.
Great. Richard, So first, where do you think we are in institutional adoption, and how is Texture assisting in that process?
Thank you. So I agree with some of the comments here. I certainly think we're very early in institutional adoption. And I hate to say it, I think we're probably about a year further behind than we were a couple of months ago in terms of institutional adoption. What's happened the last couple of months has undoubtedly scared a lot of folks out of the market. You can argue that, well, Celsius was CeFi and it wasn't really a pure DeFi. But frankly, that nuance is going to be lost on most of the institutional participants who want to get into the space. I think, it's also like, let's define it. What does institutional mean? So there's folks like Ahmad at the end there, who runs a hedge fund. We call them an institution, but it's not your more traditional financial institutions that we think about. You're managing the bulk of wealth in the US. It's going to take these folks. Even Fidelity is perhaps the most forward-looking of all of them. They're very still just dipping their toes in, offering a very simple, plain vanilla Bitcoin type product. So what do I think it's going to take to get folks in? Well, think things like Jason was just talking about, some kind of permission DeFi. Arc is doing that as well. We're kind of, as a regulated institution, I don't know if I mentioned this before, we're SEC regulated, we're FINRA regulated. We can be that KYC provider, that on-ramp to these networks, these kind of closed pools, as it were. And I think there's also many other roles that we can play in the space. I actually had the idea for this company after the last crypto blowout, which was the ICO boom in 2018, 2019. We got moving here, and I think what we've seen is that there's going to be a need for more regulation. It's not like definitely around lending type products, and that's kind of where we see ourselves fitting in as we move forward here.
So on that topic, are you helping the SEC, for instance, figure out what's a security under the Howey test, or?
Well, I think I don't know how to answer that. I mean, the SEC has said the Howey test is the definition they're using for security, which is basically if it's an investment of capital with the expectation of profit based on the work of others, it's an investment contract of some kind. We're working within those rules. Everything we do is going to be clearly defined as a security up front. We're not going to kind of try and thread that needle where it starts off as a security, but then it becomes sufficiently decentralized or whatever, or vice versa.
Safe harbor.
Yeah, yes, exactly. I think the SEC has been, obviously had taken a very tough stance. Gary Gensler is basically saying, come in and talk to us, you need to be regulated, but he wasn't giving any guidance. And I think it's kind of interesting that some of the most well-publicized things that were going on in the space was when they essentially shut down Coinbase Lend, which was Coinbase's lending product, similar to like a Celsius, I suppose, when they sued BlockFi, another lending protocol, for $100 million. And if you cast your mind back even further to the end of last year, he kind of famously subpoenaed Do Kwon at the Mainnet conference, who was behind the Terraformer. So he's probably feeling a little bit vindicated right now. So I think that the Loomis Gillibrand bill tried to move as much stuff as they could away from the SEC to the CFTC, which has historically been more open. But I think that he's got a good case to present now that kind of he should be having more oversight of some parts of the DeFi here.
So on that topic, what do you think about the bill? Well, there's 3 bipartisan bills that were presented, right? And so do you think parts of that will make it and we'll see that some of that enacted next year? Or are we just limited to getting some stablecoin regulation this year and that's the best we can hope for?
I mean, I leave that to the experts. I'm definitely not a regulatory expert, but from my perspective, as a fund, navigating today the crypto landscape with no regulation is very, very difficult, right? And specifically on stablecoins, as we were chatting earlier, the current stablecoin environment, I know we had panelists talking about stablecoin, is a mess, right? We have way too many stablecoins, some disclose, some don't disclose, a gazillion different methodology, and zero regulation, right? That makes it very inefficient and very dangerous, right? So what does the regulatory landscape look like? I don't know. I'm not a lawyer or a regulator. But having clarity and having some rules of the game will benefit everybody. Will restrict some people from doing what they want to do. I'm not sure that's necessarily a bad thing. But having some clarity will make our lives and our risk management much, much easier than it is today. Right?
Well,
Yeah, I think that the focus more so is going to be on what's imminent, right? What's the current risk in the market at the time. I think it'll continue to shift a little bit, but stablecoins being at the top of the agenda most likely now. I think that in terms of what gets implemented, it's going to be interesting to watch and see. This is going to be a longer path. I don't know if I'm curious what others think, but in reading the bill, I think there's a lot of wishful thinking or hope that CFTC does kind of take it in terms of what the digital assets may be defined as. But I think it also codifies the Howey test in the position of SEC in terms of security. So I don't think it's necessarily all-encompassing going to be under CFTC. I think for institutions to get comfortable, there definitely has to be some key points that are addressed by the regulators. One is going to be the classification of the assets. A lot of institutions don't want to hold the assets directly. We'll see some bridging products enter the market. We already have. We've seen Goldman Sachs launch and trade their NDF. So structured products, bridging products that institutions don't have to take direct, into direct control, if you will. But yeah, I don't know. I think that it's going to be a long debated path before anything gets.
And if I may add one more point to this, to echo what he's saying, is although we don't know what the final shape is going to look like, I can guarantee to you that the regulators are going to overshoot, right? We've seen it in traditional finance. I spent 25 years at Goldman and had to deal with regulators all the time. And the cycle is very simple. They come in with somewhat limited knowledge, but they have to put some regulation in place, so they overshoot, and then you educate them back towards steady state. And that will cause a lot of pain along the way, right? But it's a necessary evil to having a regulatory environment.
Well, to that point, BIS just issued a new research report, and basically it's proposal of embedded regulation. So creating a framework and then embedding regulation within the protocols themselves. And it even goes as far as talking about having controls around the consensus mechanisms. And so to your point, I think it's a little bit of overreach, right? I think there's opportunity to observe at the protocol level. We do that today, but to actually control, that gets a little scary.
So from a fin crime standpoint, like I mentioned over there, I was talking to let me rephrase that, because I got scolded for calling this particular protocol a privacy coin. The person said, we're not a privacy coin, we're effectively a coin that has privacy features. However, depending on however long you've been in crypto, they've done a ton of marketing that they are a privacy coin, but that's okay. But where I was going with that is regulators are so focused on potentially banning privacy coins. What they don't realize is that, something I realized at DOJ is every bad actor makes a mistake. We're all human, right? You don't really need to regulate the specific protocol at the protocol level. You can regulate at the exchange or on-off ramp level, right? You'll catch the illicit activity there. There's multiple tools out like TRM Labs, Chainalysis, Elliptic, et cetera, Merkle Science. They're getting stronger and faster, more efficient at catching illicit activity. So I say that because, it's wild to think that regulators want to look at the protocol level when that's really not where they should focus. It's really at the exchange and on-off ramp level.
okay, so regulations moving around depending on what fire they're putting out that day right now. But, a few weeks ago, before lending became the hot button, we were talking about Terra and Luna and algorithmic stablecoins. Does DeFi need an algorithmic stablecoin to thrive?
I'm glad you asked that because I don't think anyone's asking. I've seen a lot of questions about how can an algorithmic stablecoin exist? Well, do we need one, right? If people were paying attention, there was a couple of stable coins, USDC, and one other that didn't blip right during the Terra incident. I think we saw DAI blip a bit because its asset or its collateralized asset is ETH, right? So I don't know, right? I'm not going to say whether or not we do or definitely or don't. But what I do know is that, from a consumer protection standpoint, people want security. They want to be able to trust in the product that they're investing in and utilizing. And without a strong reserve in a stable coin, this is going to happen again. Without revamping a stabilization mechanism, this will happen again.
Unless you have good regulation.
Correct, right. So I think something very, very important is that whatever stablecoin it is, whether it's algorithmic or not, I think you need to utilize an exogenous asset, not an asset that has volatility exposure, right? You don't want to use Bitcoin, ETH, right? You should use something else to back up the stablecoin, in my mind.
And even then, we talk about these assets, even if it's maybe USDC is the blue chip asset right now, or maybe it's something else.
Sure.
But even those the assets behind those assets are TradeFi assets, which are subject to, mark to market downgrade, right? So whether it's CP or treasuries, as we can see, right? Unless you have the ability to run stress tests on these assets, like the Fed did with the banks, right? You are going to have risk, right? So the only way to do it is to have real regulation, have real stress tests, say what you can and what you cannot do in terms of reserve for the stable coins, right? And then have clarity around it. Because otherwise you're going to get into those traps of, is this algorithm better than that algorithm?
Correct.
Or is this collateral better than that collateral? And that's not our job.
Right.
We want to invest money, not deal with underlying collateral. So we need regulators to help us do that, going back to your reg question.
I think that's a good question, because you're implicit in your question was, do we need an algorithmic stablecoin for DeFi to thrive? Implicit in that is that if it's not algorithmic, you're using a peg stablecoin, so you're tied into the traditional fiat ecosystem, and it's not purely DeFi. So I get it. It's interesting. I don't think we need it right now. I think what we need is other things. We need a stablecoin that is regulated, that maybe has some consumer protection around it, so you've got some FDIC type guarantees. That's what we need right now to give people confidence to come into the space.
Right.
And then we can worry about how decentralized it really is.
Right.
Absolutely.
I think this last few weeks has shown us, it's a test of systematic, systematic risk, right? We've seen that happen in traditional markets. We went through that in 2008. We felt the pain from that. It's good to experience it early on and see where it's at. And this is kind of that test early on. The ripple effect of what's happened over the past, couple of months here, we haven't seen the full impact of the ripple effect, right? I think over the next week, 2 weeks, we're going to hear of other firms that have felt that impact. I personally think there's room for, a pegged sovereign stablecoin. I think there's room for, and the industry will push for an algorithmic stablecoin. And I think, it's a systemic risk issue that has to be considered when architecting that. Regulation is going to help with that, I think. But I think we could expect that, algorithmic stablecoins are going to only improve over time as they evolve.
Right.
I think what I'm hearing is, so we had DeFi summer, right? We've seen TVL down since. And until some stablecoin regulation is passed, that's what you're predicting when the next DeFi DeFi season happens, right? Is that what I'm hearing?
It's hard to predict the future, but I think that's a necessary requirement. If we want to see real growth and we want to see institutions come in and be active in that space, that's definitely a prerequisite. I'm not sure if that's going to be the catalyst for the growth of the platform.
I think one thing that you and I were talking about is a lot of people are focused on DeFi and not as many people are focused on our DeFi, regulated DeFi. And I think I'm going to go out and make a bold statement that in the future, DeFi as we know it, will no longer exist, our DeFi will. And the reason I say that is because consumers, institutions are all going to follow the liquidity. The liquidity is going to dry up when you've got, the top 20 institutions, global institutions dumping trillions of dollars into our DeFi where they can play, right, and transact effectively under a regulated regime. And the DeFi as we know it will start losing liquidity. Now, bad actors are going to be on crypto Twitter and all sorts of forums, Reddit, saying like how bad permissioned is and we need a stance against, true permission, and it's an oxymoron, regulated DeFi and all this stuff. But at the end of the day, I can tell you this, I know for a fact 100% that these regulated institutions will not be able to play in in regular DeFi. It must be regulated.
I mean, already you can't get your money into out of DeFi without going to an exchange without
Sure.
doing KYC and AML
Right.
on it. You've already got it there.
Right.
Great. Well, thank you so much. I think we're out of time now. So round of applause for our panel.